Looking for a fast-charging, ultra-responsive stylus for your iPad? Meet the 2X Fast Charge Active Stylus Pen, designed for 2018 to 2025 Apple iPads. Take your creativity and productivity to the next level. Click the link in the video description to shop now on Amazon.
Welcome to Quorra, your go-to destination for the latest market insights and trends. Today, we're talking about a fascinating topic that's got investors and strategists alike buzzing. Are high valuations of the S&P 500 becoming the new normal? As the S&P 500 trades near its historical peak, experts like Savita Subramanian at Bank of America are rethinking their benchmark for what's considered normal. Instead of expecting price-to-earnings ratios to revert to their historical averages, they're viewing the current elevated valuations as a new norm. And it's not just about the numbers. AI adoption and robust earnings growth are reshaping market logic. Now, let's take a look at some data. Sam Stovall, Chief Investment Strategist at CFRA Research, notes that while current valuations remain above long-term averages, they're actually more reasonable compared to the past 5 years when large-cap stocks dominated and fundamentals were strong. Over the past 20 years, the long-term average forward price-to-earnings ratio of the S&P 500 has been around 40% higher. But with large tech stocks driving market capitalization and profit growth, that premium has narrowed significantly. But what does this mean for investors? Well, it's not a bubble just yet. Ed Yardeni emphasizes that while the current S&P 500 forward price-to-earnings ratio is close to the peak of 25x seen during the 1999 tech bubble, corporate earnings have grown in tandem with stock prices. And with technology and communication sectors accounting for an impressive 44% of market capitalization today, a record high, there's still room for future revenue and profits to grow. Now, some experts are warning about the risk of a melt-up, where investors chasing year-end performance drive up stock prices rather than causing a collapse. Gene Goldman, Chief Investment Officer of Cetera Financial Group, says that strong earnings expectations for 2026 and interest rate cuts by the Federal Reserve could actually expand market participation and sustain elevated stock market levels. So, what's the bottom line? As we look at the current market landscape, it's clear that high valuations are here to stay, but they're not necessarily a cause for concern. In fact, with robust GDP growth, resilient consumer spending, and high cash levels outside the market, Wall Street is cautiously optimistic about the future. And if you're an investor looking to ride out the waves, now might be a great time to take a closer look. That's it for today's episode of Quorra. Thanks for tuning in.